very important voice. Indranil Pan, Chief Economist of Kotak Mahindra Bank, joins us right now on the show. Indranil, good to have you. Thanks so much for taking the time out. A two-part question really. One, that the first part of my question really is that the program or the numbers that have been stated right now with the first half numbers, the borrowing numbers coming at 3.5 to 3.8 lakh crores and at 5.1% or thereabouts of as a percentage. You think that's worse enough? And two, there is a strong talk amongst a few people that we spoke to that the government will definitely overshoot the targets that have been set right now at the start of the year for FY13. How bad do you think that can get?
I think overall perspective I'll come later, but I think the first question is that 3.5 lakhs or 3.6 lakhs lakh crores, whatever that number is for the first half, itself is quite a sort of an unnerving number, because what that necessarily means that even with the redemption of about 85,000 crores, there would be significant amount of supplies in the market. But let's not also forget that there would be adequate T-bill supplies, because a lot of T-bills will also come up for redemption, and the government need to sort of make good for those. Now overall, therefore, I think just on the dated securities, the borrowing number that comes to mind is about a 15,000 to 16,000 crores, which is a significant pressure given the type of liquidity constraints that we are seeing right now. So that answers the first part of your question. The second part of the question is definitely yes, the 5.1% number could be questioned, because number one, there could be some problems on the revenue side, given the fact that the budget itself has taken a 7.6% growth target, while we ourselves are actually looking at a 6.6 to 6.7% target. So there could be some downside in terms of the taxation side. The second downside could once again be on the disinvestment side, and the third downside could be the 40,000 crores that they have targeted for the sale of the 2G licenses. Now, given all this perspective, the revenue side therefore looks to be could be actually turning out to be weaker than has been expected in the budget. And on the expenditure side, I think the clear answer is the oil subsidy bill, which is nothing has much been provided for in terms of the FY13 numbers. Whatever has been provided for would be mostly to be making good in terms of the Q4 payments to the oil companies. So there could be some upward surprises on the expenditure side too, which necessarily means that the fiscal deficit as a proportion of GDP could actually be turning out to be around 5.4 or 5.5% as a proportion of GDP as we end the year. So that's broadly the perspective, which necessarily means that the supply pressures of the government securities, and let's not also forget the state loans, and the pressure of the state loans have actually increased over the last year, simply because the collections under the small savings has not been too good. So the overall pressure continues to be on the interest rate dynamics in India.
But by front-loading a chunk of the borrowing program, Indranil, do you get a sense that now perhaps we could have pushed back the rate cut cycle that the government, or rather the RBI, was supposed to initiate, because they have constantly expressed inflation to be a concern, and with such a big borrowing program laid out, there would be near-term inflationary pressures?
I would to a certain extent actually think contrary to this logic, in the sense that yes, the inflation pressures are there, which you can't really do away with, because oil prices globally are firm, you have a depreciating currencies, etc. But if you really look at from the Reserve Bank's point of view, to a certain extent it might have to want to sort of provide some amount of leeway and comfort to the government borrowing program. So from that perspective, I would still say that there could be a 25 basis points cut coming in April. What we can debate, of course, is whether it's 100 basis points cumulative for the year, or whether we actually stop short at either a 50 or a 75 basis points. But I would still confidently point out that the RBI needs to provide the signal of the fact that interest rates have peaked out and interest rates are likely to drop. So the first 25 basis points we are still expecting to come in April.
There is, of course, pressurizing the bond markets, which is why yields have shot up. But aside of that, there are question marks about the inflationary pressure that it may build and how it may crowd out private investment. Before we come to the aspect of, how this may be crowding out private investment, Indranil, just to take on where you see bond yields headed, because there was an expectation that with the kind of pressure that we would see in the first half, yields could cross 9%.
I'm not sure about the 9%, but the yields could be actually headed up towards the 870, 875 zone. Now I'm more or less confident that the OMO might not be used as a tool in a very aggressive way in the first half of the financial year, because I think there could be some operational restraint in terms of the way the OMOs can be used on a very repetitive basis. So the RBI would possibly be keeping that firepower of the OMO reserved for the second half of the financial year, when, as we were sort of talking about the fact that the borrowing program could increase from the budget levels, which is more a likely incident for the second half rather than the first half. So given that, I think the peak out in terms of the 10-year yield could be at around 870, 875, and as the OMO starts, we could actually retrace back towards an 820, 825 zone. But I would not be sort of extremely aggressive in terms of the downward momentum of the bond yields, unless the liquidity perspective improves in a very significant way.
Would you have expected this borrowing program to be planned in a different manner, Indranil? Because, the RBI has also stated that managing such an enlarged borrowing program is a challenge. There seems to be a bit of a difference in opinion between what the government has laid out and, what the RBI now needs to follow up. Do you think that they could have done this differently, the borrowing program for FY13, they could have laid it out?
I'm not sure how differently they could have done it, because they anyway have a redemption pressure of 85,000 crores out of the total redemption of about 90,000 crores for the full year. So everything is concentrated in the first half of the year, and therefore the pressure in terms of the borrowing numbers would obviously be felt in the first half of the year, apart from the standard expenditures that the government would need to do. So I'm not sure how differently they could have done. While having said that, I think they have the room in terms of the cash management bill, which they have actually budgeted at about 95,000 crores to be repaid back fully in the same financial year, of course, in terms of trying to manage out the mismatches that might happen in terms of the liquidity flows for the government. But beyond that, I think the government borrowing program needs to be stronger in the first half of the financial year itself.
Okay, leave it at that, Indranil. Thanks so much for taking the time out and joining us for this perspective. Good having you on the show. Well, that's the view of Kotak Mahindra Bank Chief Economist Indranil Pan on the government borrowing program.